Hello everybody, Dr. Phil here. So this is a video on accounting for current liabilities. So the first thing we're going to do in this video is we are going to define liability. So what is a liability? So we'll kind of go over this definition and I'll give you some extra info too. So a liability is caused by a past transaction or event. So think about someone like employees have worked for you, but you haven't paid them yet. You've ordered inventory, you haven't paid for it yet. Company has now a present obligation to pay basically money in the future. So think of liabilities, long term even, but certainly short term here, as things that you owe, money that you owe that you haven't yet paid. So we classify liabilities. It's very similar to current assets with respect to the delineation. Current liabilities are basically going to be due within 1 year or the company's operating cycle if that turns out to be longer. Most times it doesn't. And then that's current liabilities, and then long-term liabilities is basically anything over a year or the operating cycle again, if longer. So most times, just think of the year. If it's going to be due, if you've got to pay it within a year, it's going to be a current liability. If it's more than a year out, then it's going to be classified as a long-term liability. So just some examples for you. You can see, Dick's Sporting Goods. You can see they have a lot of current and long-term liabilities, and then just yeah, companies in different industries that certainly represent different industries. So these are some examples of liabilities. Now, what you see here, this is not an exhaustive list. There are certainly more than this, but things like accounts payable. Sometimes we'll call that trade accounts payable. That's typically where you're like purchasing inventory through, for example. Sales taxes that you have to remit to the local municipality, the federal government, etc., the state Department of Revenue. Unearned revenues, money that you've received that you haven't done the work for yet. Notes payable, just think of a loan. Basically, you took out a loan and you're going to have to make payments on that loan. Payroll obligations, obviously your employees are not there for free. And then what we call multi-period known liabilities. So we'll talk about some more of these now. So let's take a look at an example of sales taxes payable. So on the last day of August, August 31, Home Depot sold materials for 6,000 that are subject to a 5% sales tax. So the first thing we'll do is we'll go ahead and record the cash. Now you notice there's a debit or an increase to cash for 6,300. So how did they get that? Well, it's basically the 6,000 that they sold. They're also collecting on top of that the 5% sales tax, as you can see in the bottom right here. 6,000 times the 5% that's your 300. So they're going to get 6,300. They're only going to keep 6,000 of it. Their revenue, the other 300 is going to be remitted to the government. So we're going to credit sales for 6,000. That's an equity account, normal credit balance. We're going to increase sales with a credit. And then we're also going to increase the liability account, sales taxes payable, in the amount of 300. And then once we pay it, we'll then remove it. So here's an example of unearned revenues. So on the last day of June, June 30th, Selena Gomez sells 900,000 in tickets for 3 concerts. So the money's being paid. So we're going to increase cash for 900,000, debit to cash, and then we're going to credit the liability account unearned ticket revenue in the amount of 900. And then it says on October 31, Selena performs a concert. Now remember, she got 900,000, but that was for 3 concerts, right? She's just doing one. So now what they're going to do is they're going to debit or decrease the liability account unearned ticket revenue, and they're going to credit the regular revenue account. That's an equity account. So that's increased with a credit. So you can think of the entry on October 31st as we're just kind of moving it out of unearned and moving it over to regular revenue. All right, short-term notes payable. So written promise to pay a specified amount on a stated future date within 1 year. So most notes are going to bear interest. Again, when you hear the term note, just think about a loan. It's really just a loan. The note is a banking term. And it may arise from overdue accounts payable that have been converted to notes payable, or borrowing from a bank even. So let's look at an example of a note given to extend a credit period. So basically, as of the date of the replacement. When they say the date of replacement, the date they converted the note to they converted the account payable over to the note payable. So it says on August 23rd, Brady Company asks McGraw to accept $100 cash and a 60-day, 12%, $500 note to replace its existing $600 account payable. Okay, so what are they going to do here? Well, the first thing they're going to do is they're going to remove the account payable because they had an account payable sitting there for $600, so that's going to be removed. They're going to remove it with a debit. That's going to decrease the liability. They're going to increase cash by 100 because they're paying out. Excuse me, they're paying out 100, so they're decreasing cash by 100, and they are increasing notes payable in the amount of 500. So accounts payable's gone down by 600. Cash cash has gone down by 600, and then notes payable has been increased by the 500. So what they've really done here is they've just converted it to a loan. So on October 22nd, Brady pays the note plus the interest to McGraw. So what we're going to do now is they're going to remove the note payable, a debit to notes payable. Again, liability account, normal credit balance. This is removed with a debit. Interest expense, they made $10 in interest. That's, you can see down here, 500 times 12%, and then times 60 over 360. So basically for those 2 months. If you're wondering why they used 360, that's a banking convention that started in the UK a long time ago, to account for like bank holidays where they're closed. And then we're going to credit cash, or they're going to credit cash in the amount of 510. All right, note given to borrow from the bank. So on September the 30th, a company borrows $2,000 from a bank at 12% interest for 60 days. So the first thing they're going to do is they're going to increase cash. They're going to debit. It's an asset account, increase with a debit. Now think about why they're getting cash. So it's going to be increased. Notes payable is a liability account. That's going to be increased with a credit. So what they're basically saying is, okay, yeah, we got cash, but we also have to pay it back. So we've increased notes payable to recognize that. On November 29th, the company repays the principal of the note plus the interest. So here you can see we have a debit to notes payable. So they're now removing the note payable, right, with a decrease that they increased up here on September the 30th when they first took out the loan. Loans going away now, it's been paid off. So the note payable is being decreased by 2,000 to bring it back down to zero. They're going to make some interest. They're going to make $40, 2,000 principal times the 12% interest rate, and then again times 60 over 360 again, think about 2 months. And then the cash that they're going to have to pay is 2,040. So cash, again, asset account, normal debit balance, well, cash is now going out. It's got to be decreased. So we do so with a credit. So what about when a note extends over 2 periods? So here you can see like the note date, excuse me. So let's say this is like 2022, and then it ends, or the end of the period, like December 31st, 2022. Now we're in 2023, and it ends up starting in 2022 and ending in 2023. So we have to make an adjusting entry on the last day of the accounting period to reflect any accruals, in this case interest expense, that have occurred just up to that point. So let's take a look at an end of period adjustment to notes. So it says on December 16th, 2021, a company borrows 2,000 from a bank at 12% interest for 60 days, 2 months. An adjusting entry is needed on December 31, so you can see where they debited interest expense for 10 and they credited interest payable also for 10. So interest expense is being increased, interest payable is being increased as well. Now, think about what's happening on December 31st. They're not paying the interest yet. They're just accruing it. They're just saying, okay, we're not going to pay this until the end of the note, like when it matures, when it ends. We're just recognizing that we need to record $10 of interest expense in this period, in this case, 2021. Then it says on February the 14th, 2022, the company repays the principal and interest on the note. So now what they're going to do is they're going to debit interest expense for the other $30, and you can see the calculation down here. 2,000 principal times 12% interest times 45 over 360. So that's basically the 45 days that it ran in 2022. They're going to remove with a debit the interest payable. Again, that's a liability account, normal credit balance. It was increased up here. Now we're removing it because it's being paid. And then we'll have a debit to notes payable in the amount of 2,000. What is that doing? It's just removing the notes payable because they're paying it. And then they're recognizing that they paid it with a credit to cash. So that, again, cash asset account, normal debit balance. We want to decrease it, not increase it. So we're going to do so with a credit in the amount of 2,040. All right, let's talk now a little bit about payroll liabilities. So these payroll liabilities are from salaries and wages. These are just some examples: employee benefits and payroll taxes levied on the employer. So here are some examples. These are if you're working, you get a paycheck. You're probably very familiar with these, right? You're gonna have your gross pay, and then they're gonna take out federal and state. They're gonna take out FICA, Medicare, and Social Security. And then any voluntary deductions, that could be things like health insurance contributions, accidental death and disability insurance premiums, vision, dental, so on, maybe contributions to a 403b or a 457, 401k, any of those types of things. So the first thing we'll talk about, as far as deductions go, is what we call FICA taxes. So there's really two components of FICA tax. This Social Security aspect, that's taxed at 6.2%. And then Medicare is taxed at 1.45%. Now, the key difference between these two is that Medicare, you just tax on that index. It doesn't matter how much you make, you're always going to pay that 1.45. The Social Security, however, is not. As you can see, in 2020, it was 6.2% on the first 137.7 earned in the year. So if you make more than, like if you go over the 137.7, then that 6.2% drops off. You no longer have to pay it. A lot of students will ask me why that is. Well, the reason is simple. It's because the benefit you can get when you retire from Social Security is capped at a certain amount. So in order to keep it fair, they have to cap the amount you're taxed at a certain amount as well. So think about why that makes sense. Okay, employee income tax. I'm sure you're overly familiar with these. Typically, it's going to be federal, state, and local. And the amounts withheld, of course, depend on how much you made, what your tax rates are, and then the number of withholding allowances. And then the employers, the people that withhold the money from you, your company, they've got to pay those taxes to the appropriate government agency. All right, more voluntary deductions. So amounts withheld, of course, depend on the employee's request. I kind of touched on some of these already, like union dues, pension contributions, medical and life insurance. And then again, those are going to be withheld by the employer. They're not probably going to be sent to the government. It's going to be sent to, like the union, for example, whatever the designated agency is. So recording employee payroll. So this is an example of an entry to record employee payroll. So if we see we have a debit to salaries expense, so we could say that let's just assume this is one person. The person made $2,000, and then you can see where. So this is like their gross pay, the 2,000, and then you can see where they took out all the various amounts, and then you can see salaries payable is going to be the 1524 that they actually receive. They haven't received it yet. Again, salaries payable. They'll receive it in the future, and then the journal entry to record the actual payment of this of the salary would just be a debit to salaries payable. If you look at the January 31st entry, this compound entry here, it was increased. Salaries payable with a credit, again, liability account, normal credit balance. So now it's being debited or decreased. Salaries payable because it's being removed, it's being paid. And then the company's going to record a credit to the asset account cash to decrease their cash balance by 1524. All right, employer payroll taxes. So you may or may not know that in addition to you paying your FICA, the Social Security, and the Medicare, your company has to also match that. That's why you got to be careful if you ever become a contractor, because if you become a contractor, like a 1099 employee, you are considered the employee and the employer, so you have to pay both. So that's in essence the FICA tax doubles. So employers must they pay the amount equal to that withheld from the employee's gross pay. So if you're just like a W-2 employee, this is probably not something you have no reason to really know this. The companies don't really tell you this, but then they just withhold it, and then of course they have to pay that also to the respective agencies and authorities. So this is what we call FUTA and SUTA, federal unemployment and state unemployment tax. And this is it's kind of cool how they do this. So like federal, it's 6% on the first 7,000 of wages paid to each employee, but a credit up to 5.4% is given for SUTA paid. So therefore, the net rate is about 0.6%, the difference between the 6 and the 5.4. Now, the way they do this is the credit up to 5.4% is usually based on employee turnover. So it's like a way for the federal government to incentivize low turnover. They don't want people losing their jobs, quitting, because then, that can sometimes become a burden to the state, the federal government. So that's kind of the way they incentivize employers to try to keep their turnover low. And then state unemployment tax, that's 5.4% on the first 7 grand of wages paid to each employee. And then if the company is able to achieve good merit ratings, it may also, like I said for the federal, it may also lower their SUTA rates. All right, recording employer payroll taxes. So this is an example of kind of how this would probably look. So they would debit payroll taxes expense. In this case, it's 273. And then you can see all these credits to all these different payables that they're going to have to pay Social Security taxes, Medicare taxes, and then federal and state unemployment taxes. And you can see down here the amounts, just if you're wondering, like, okay, how did they get the 108, 2,000 times 5.4%? Or how did they get the 12, 2,000 times 0.6%? So on and so forth. All right, so what about internal control of payroll? So there's really four key areas of payroll activities that we should separate and monitor. The first one is employee hiring. The second one is payroll preparation. The third one is timekeeping to make sure people aren't cheating on their time. And the fourth one is payroll payment to make sure that the right amounts go to the right people at the right times. Okay, so let's talk a little bit about multi-period known liabilities. So the easiest way to understand this is to look at a couple of examples. So the examples that I picked were unearned revenues and notes payable. So unearned revenues are exactly what they sound like. Money that a company has received that they haven't done the work for yet. So these could come from things like magazine subscriptions. They often cover more than one accounting period. Um, Portion of the earned revenue is recognized each period, and the unearned revenue account is reduced. So, like as you slowly earn the revenue, you slowly move money out of unearned, move it over to regular revenue, the equity account. Notes payable. So, notes payable often extend over more than one accounting period. A 3-year note would be classified as a current liability for 1 year and a long-term liability for two. Remember the delineation, the cutoff, the threshold is 1 year, right? So everything that's due within that note, that loan within like 12 months or less from now, that's going to be current. Everything over 12 months is going to be long-term. Estimated liabilities. Might sound strange, but companies do sometimes run into this. So an estimated liability is a known obligation of an uncertain amount that can be reasonably estimated. So things like pensions, healthcare, vacation pay, like warranties is a good example because you've given warranties, but you don't know ahead of time how many people are going to claim. Let's take a look at an example utilizing health and pension benefits. So employer expenses for pensions or medical, dental, life, and disability insurance. So these are just some examples. So if we assume an employer agrees to pay an amount for medical insurance equal to 8,000 and contribute an additional 10% of the employee's 120,000 gross salary to a retirement program. So this is kind of how this compound journal entry would appear. So they'd have a debit to employee benefits expense, the 20,000, and they would have a credit to medical insurance payable and a credit to retirement program payable. So 8,012, they haven't paid it yet. Of course, it's a payable, right? Future tense, they'll pay it in the future. So the 8 and the 12 is where they're getting the debit, the increase to employee benefits expense. Vacation benefits. So let's assume that an employee earns 2 weeks of paid vacation each year. So the first thing they would do is they would debit vacation benefits expense, in this case in the amount of 3,200. So apparently the person makes 1,600 a week, and then they would credit vacation benefits payable, and they would do that ahead of time. Now, what about when the employee actually takes some vacation? So if the employee takes apparently $400 worth of days, then what they would do now is they would debit vacation benefits payable. Remember, it was increased on December 31st, so they made the allowance for 3,200, and they've now used up 400 of that because the employee has taken a couple of days. And then, of course, they would credit cash in the amount of 400 because it's paid vacation, right? You still have to, still got to pay them. Bonus plans. So assume that a bonus of 10,000 will be paid to all employees. So the employee bonus expense would just be a debit for increase for 10,000. And then the bonus payable, again, it's not been paid yet. Just remember, anytime you see payable, it's not been paid yet. And then they have a credit to bonus payable in the amount of 10,000. So let's talk a little bit more about warranty liabilities. So I think most of you probably know what a warranty is, but in case you don't, this is the seller's obligation to replace or fix a product or potentially a service that fails to perform as expected within a specified period. The seller reports the expected warranty expense in the period when revenue from the sale is reported, because again, they're trying to match expense with revenue, and the seller reports the warranty as a liability. So it's kind of they're kind of making an allowance for this ahead of time. So here's an example. So on December 1st, 2021, a dealer sells a car for 16 grand with a maximum 1 year or 12,000 mile warranty covering parts. Past experience indicates warranty expenses average 4% of a car's selling price. Okay. So what we have here is we have a debit to warranty expense. I'll talk about the amount, that's 640 in a second, and a credit to estimated warranty liability. So the 640, just the 12,000 times 4%. You can think of this as this credit to estimated warranty liability. That's where they're making the allowance, the provision for what they think they may use in the forthcoming period. Then it goes on to say, on January 9th, 2022, the customer returns the car for repairs. The dealer replaces parts costing 200. So now we have an estimated warranty liability that they've now used. So it's going to be a debit to think about the credit up here for 640 to make the allowance. They're now using up 200 of that warranty liability. So they're decreasing it by 200 with a debit. And then they have a credit to auto parts inventory. So any kind of inventory account is an asset account. They're just basically saying, hey, we used up some inventory to fix whatever the problem was. All right, accounting for contingent liability. So think about what the word contingent means. It's something that could happen that maybe doesn't. So a contingent liability will be recorded in the books if it's probable, if it's possible, or if it's remote. So let's look at how this works out. So if it's probable, and then okay, fine. So it's likely going to happen. Then can we estimate the amount? If the answer is yes, then it'll be recorded in the financial statements, right? If it's probable, but we can't estimate the amount, then we'll just disclose that in the qualitative section, the notes to the financial statements. If it's possible, then again, it's going to be disclosed in the notes. But if it's really remote, then there's no disclosure. Now, of course, as a quick caveat here, then a lot of this is very subjective. Manager A says, well, I think it's probable, or maybe it's possible. Manager B says, well, I think it's remote. So that could be, that judgment call could be the difference between whether it shows up in the actual financial statements in the quantitative part, whether it shows up as a disclosure in the qualitative piece, or it just doesn't show up at all. So as an example of reasonably possible contingent liability. So potential legal claims. So a potential claim would be recorded if the amount can be reasonably estimated and payment for damages is probable. If the potential claim cannot be reasonably estimated, but it's reasonably possible, then like we saw in the chart, it would be disclosed. Things like debt guarantees. If somebody has guaranteed somebody else's debt, the guarantor, that's the company that's guaranteeing it, usually discloses the guarantee in its financial statement notes. If it is probable that the debtor will default, the guarantor will then report it as a liability, actually, in the financial statements for the amount. Other contingencies, that could be environmental damages. Think about like oil spills, for example, possible tax assessments, insurance losses, and like government investigations, like maybe the IRS. They say, well, we disagree with your tax position. We think you owe more. So that would be an example. So uncertainties that are not contingencies. So uncertainties from future events are not contingent liabilities because they are future events and do not arise from past transactions. So those do not get disclosed. Okay, almost done. Times interest earned. So this is like I say in every video, once you get to the ratio, it's good times because you're almost done. So times interest earned is income before interest and income taxes. It should say interest expense and income taxes, and then just divided by interest expense. So think of this as the number of times that interest expense will basically go into operating income. So if income before interest and taxes, if it turns out that it varies greatly from year to year, then fixed interest charges can increase the risk that an owner will not earn a positive return and be unable to pay interest charges. So we're kind of looking for as high of a multiple as possible when it comes to the TIE. So a couple of examples here. See some of the information here for Diego Company. So we know that the formula is income before interest expense and income taxes divided by interest expense. So you can see, like for 2021, we took the 150, income before interest and taxes, and then just divided it by the 60, which is the interest expense. Per the formula, we get 2.5 times. So basically what they're saying is we can cover our interest 2.5 times with our operating income. All right, that's it for this video. Thanks as always for watching, and I will talk to you all soon. Take good care.